Hello and welcome to today's special event, Outlook 2021, or as I like to call it, the Joe Biden inauguration pregame show. We all know that the world's been pretty crazy in general, and that certainly includes global financial markets. 19 days ago, we turned a new page called 2021, and we've continued to see significant world political events unfold. Most equity markets continue to advance while bond markets retreat. So we gather here this evening, Tuesday, January the 19th, and are joined by 5 of our favorite money managers and analysts. Each has a different area of expertise and focus. My name is Bob Simpson. I'm joined by Paul Tyers, Managing Director and Portfolio Manager at Wealth Stewards. Tonight on our distinguished panel, we have Paul Ashworth, Chief North American Economist at Capital Economics, James Tesindis, Portfolio Manager for Munro Partners. James joins us from Australia this evening. Excuse me, David Fingold, Vice President and Senior Portfolio Manager at Dynamic Funds. Kate McDonald, Vice President and Portfolio Manager at Signature Global Asset Management. And last but not least, Paul Sandhu, President and CEO, Marret Asset Management. The format is a series of one-on-one due diligence interviews. With each interview, we will be seeking to learn a little bit about each panelist. As 2020 was such a different year, we want to learn what each panelist learned as the events of 2020 unfolded, and then most importantly, their outlook for 2021, risks, opportunities, and trends to help us to position our portfolios for success in 2021. During each interview, you have the opportunity to ask questions. Just click on the Q&A button at the bottom of your screen, and we'll present your questions, time permitting, during the interviews. Each interview is 12 minutes in duration, so get your questions in early. Now, before I begin, I want to thank all of our attendees this evening. Your time is valuable, and we are thrilled that you've chosen to spend it with us this evening. Now, I don't want to cut into the panelist time, so let's get started with Paul Ashworth. Paul Tyers, you've been a longtime follower and subscriber to Capital Economics Research. How about kicking off tonight's session with some questions for our first speaker?
Thanks, Bob. And I also want to welcome everyone this evening to our Outlook 2021. Paul's right, we have been long-term subscribers to Capital Economics, and we have here tonight Paul Ashworth, the Chief North American Economist for the company. And Paul, I wonder if you could just share with us a little bit about yourself and the work that you do at Capital Economics.
Sure. So I'm a macroeconomist. That's what I am by training. I have a PhD in economics. And for the last 20 years, I've worked at Capital Economics, which started as a small macro shop in London. When I joined in 2001, we had 6 of us, and now we're up to 4 offices around the globe with about 60 economists and a staff overall of about 150. So it appears to be going in the right direction anyway.
Looking back at 2020, I wonder if you could share the things that you learned. I think we all learned a lot, and that you believe will help you navigate the financial markets and what you do in the upcoming year, the current year that we're in.
Well, certainly 25 years as a macro forecaster, I've been wrong a fair number of times during that period, and right, hopefully slightly more times than I've been wrong. But, last year was a good reminder of the humility you need to have in this business, because you can get knocked sideways by these unknown unknowns. In this case, it was the pandemic. Even when it became a known unknown, when it was in China, I think for a while, markets and myself included didn't appreciate that with asymptotic spreading, without symptoms, it could spread, and it was very aggressive and therefore could very quickly move around the world. And I think we also underestimated is how aggressive governments, even in developed markets and democracies, have been in restraining activity in terms of lockdowns. We knew that was the case in China because it's a fairly authoritarian regime, but to see some of the individual freedoms curbed in countries like Canada and the US, I think is almost unprecedented. And of course, that led to an unprecedented decline in economic output, GDP. We were getting some of that back. We've had a bit of a knockback over the last couple of months. But overall, given the big dose of economic stimulus we've had in terms of both fiscal stimulus and monetary stimulus, most developed markets haven't done too badly in terms of economic output. And certainly equity markets have recovered quite well too.
So as you look at 2021, certainly I think a lot of people in this on this panel identify risks and opportunities. What do you see as the major risks for this year, and perhaps just spell out a sort of a worst case scenario, and then we will look at the other side of the coin as well.
Well, I mean, I think overall we're fairly optimistic. And there's two reasons for that. One is the policy stimulus that we're likely to see, particularly coming through in the US with the new Biden administration. Biden's already announced that he's looking for almost $2 trillion in additional stimulus, which is 9% of US GDP. On top of that, we would expect the Federal Reserve to remain very accommodative, won't even think about raising interest rates for several years. So that gives you a very accommodative policy environment. And on top of that, we should see the vaccine rollouts progressing to the point where the coronavirus hopefully will be defeated. It's important that we've got very effective vaccines. We weren't assuming the efficacy would be as high as 90 or even 95%, but that appears to be what we have for the Moderna and the Pfizer vaccines. So that gives us a real shot at a return to normalcy. At the moment, the economy is doing okay, but certain sectors like travel, leisure, and hospitality are still suffering both sides of the border because of the physical distancing requirements. But if we can get the vaccine rollouts to work, then we should be able to get back to normal, particularly, as I say, boosted by that policy stimulus. But there are considerable uncertainties about that, massive uncertainties here about, as you can see on this slide, the production of these vaccines, the logistics, and also about whether new virus variants will, develop that make the vaccines essentially useless. We've already seen with production here in Canada, we're having problems getting the Pfizer vaccine coming from the Belgian production plant, so that's not Canadian vaccination program back a bit. The US is doing better because it's relying on its own domestic production, and is up to vaccinating about 800,000 a day, which is very promising. But again, there are still uncertainties there, and I think that's probably one of the key downside risks to what otherwise would be a very upbeat scenario for this year. I do think central banks are going to leave interest rates very low at near zero for at least the next few years. And that's the case both here in Canada and in the US and across the developed markets. And of course, I think that's going to be good for risky assets. Within that, I think there's more gains to be had among equities in key markets, maybe other asset classes like property, certainly residential. But within that, I think you do need to be careful because it's always possible with so much easy to borrow, low cost money that you will get bubbles blowing up. So we do need to be wary of those if we see assets getting too far away from fundamentals. And the final one is inflation. Obviously, for the last 20 or 30 years even, we've had a very low inflation environment. But I think coming out of this recession, we have a couple of factors that make me think that maybe it'll go in the other direction. One is this massive amount of policy stimulus we're seeing, that the policymakers won't be able to pull it back in time, and they'll run the economy too hot across developed markets. And there are other structural factors. I mean, over the last 20 years, we've had globalization, which is reduced tariffs pushed down the price of imported goods as manufacturing has been outsourced to cheaper Asian countries. But now we seem to be in an environment almost of deglobalization. Tariffs are rising, production's coming back to higher cost bases, and that all points to higher prices in the future. So if I'm looking at anything, the surprise will be that inflation could be a bit higher than we've been used to in recent years.
Thank you. And then maybe on the other side of the coin, some of the trends that you see that there may be some opportunities either in just in the year or even a little bit beyond that.
Well, certainly if we're right and we get a return to normalcy, I think there are still opportunities in terms of overall equity markets. And within equity markets, you would expect to see something of a rotation. Of course, over the last 12 months, what we've seen is things like tech stocks doing particularly well, whereas those sectors that are still affected by things like physical distancing, like leisure and hospitality, have lagged. I think what we could see over the next 12 months is something of a reversal of that. So I'd see opportunities there, certainly, not just for overall stock market performance, but from sectoral performance too.
Very good, Paul. And really, thank you. You're a busy man these days. I read some of the daily, weekly, monthly, in-depth reports that come. Very difficult to keep up with them all, but it just says how much your capital economics has its ear to the ground, literally on a global basis. I want to thank you very much for joining tonight's session.
So Paul, just before you do that, we have a couple of questions.
Okay.
Sure.
Yeah. So one from Jim, where Jim says, with the Biden administration likely to add fiscal spending in the U.S. somewhere between $1-2 trillion, will the dollar continue to weaken against foreign currencies? And what do you think will be the strongest currency over the next 3 years?
Yeah, I mean, certainly the dollar's been on a downward trend for at least the last 12 months and is its lowest level in trade-weighted terms for a couple of years. I think we'd expect that to continue. Some of that is simply because we're now in a risk-on environment, and so safe haven currencies like the US dollar and the Japanese yen are suffering because of that. In particular, Jim is correct. I mean, you've got more fiscal stimulus coming through in the US, and also even perhaps on the monetary side too, with the Fed's asset purchases. On the other side of the coin, you've got not much more room for the ECB in the Eurozone to cut interest rates much further into negative territory there. And the Europeans seem a little less coordinated in terms of pushing through more policy stimulus this year. So that does point to a slightly weaker dollar this year. And also, of course, in trade-weighted terms, one of the biggest bilateral rates now is not just dollar euro or dollar yen, it's actually dollar renminbi. And of course, because of the success China's had in bringing the virus under control there, it's got its economy back to normal much more quickly. That economy is already growing rapidly. And so the Chinese authorities are already turning to their thoughts to actually tightening policy in terms of raising interest rates. So if you think about the interest rate differentials there, the US still keeping it as basically as loose as possible and China beginning to tighten again, that all points to a weaker renminbi too. So yeah, overall, I think we'd certainly expect the dollar continue on its downward trend. As for currencies with the most upside, surprisingly among developed markets, I might actually pick out sterling. Of course, we've seen the UK actually manage at the last gasp to secure a Brexit deal. That currency is relatively beat up at this stage. The UK has suffered a bit more than other developed markets in terms of lost economic output because of the virus over the last 12 months. So I think there's possibly more scope for the UK economy to do better over the next 12 months and better relative to other G7 or developed markets, in which case we may see sterling rise.
Mm-hmm. Okay, so to try to stay on track here, unfortunately, I have a whole list of questions here, but we want to keep things rolling. So Paul was thanking you for your time. I'd like to do as well, and we'll move on to our next guest this evening. So sorry, a little bit off there. So next on the agenda this evening is James Tesindis. James joins us from Australia. Now, Emma Lynch, one of our wealth advisors, is from Australia, and she said, James, that I shouldn't say anything about the recent cricket match with India. Are you okay? Are you okay with that?
Oh, yeah, I'm okay. I don't know about my workmates, but yeah.
But you'll survive.
I'll survive.
Yeah. Okay. So thanks for taking the time to join us. Now, I find it terribly interesting to hear the views from different parts of the world, but let's start by telling us a little bit about yourself and Munro Partners and why you think it's a good idea for Canadian investors to choose an Australian manager to manage global investments.
Sure. Well, thank you, Bob, for having me along. We really appreciate the opportunity to speak. Shelby, if we could just get the first slide up, that would be great. And this is just a team slide. And so this is our team. And just the thing that I would point out that's, I think, interesting or important to us is just this, this partnership model that we have as a business. So it effectively allows us to, I suppose, bring people in and offer equity and so forth, and really align the interests of ourselves and the investors quite strongly there. And so, yeah, I would point that out as our sort of key, our key strength as a business, and I suppose our culture as well. And Bob, to your point about sort of speaking to someone from Australia, the reason I think you are speaking to someone from Australia to about sort of a fund that is effectively a global equity fund with this sort of absolute return or liquid alts, as it's called in Canada, sort of framework, is because we've actually been running these types of funds that are focused on sort of generating good absolute returns with an eye to capital preservation as well when things get difficult. We've actually been running those type of strategies down here in Australia for a couple of decades now. And the team I work for, the team that I've joined, going back a few years now, it has actually been running these types of funds for about 15 years. So my colleague there, Nick Griffin, as I say, has been running these funds for 15 years. I've worked with him for about 8 years now. And Kieran as well, we've come across from another firm called K2, which has had a 2-decade experience sort of running these types of funds. And that sort of experience comes in quite handy when you sort of hit a period like, you know, COVID last year, sort of Q1 last year, when the markets get really, really difficult. And to the last speaker, Paul's point, I mean, you never see things like that coming. So it's sort of more about how you react to them. And sort of having that mindset, that capital preservation mindset, and that experience of having gone through quite a few drawdowns over sort of 15 years in markets, that sort of experience comes through, and you sort of learn something new every time, and you sort of have a process around how to sort of deal with those types of situations. And then when things normalize, you then go and try to effectively make money again. And so I would really just sort of highlight those sort of factors in terms of our business. So first of all, partnerships, everyone highlight line, and then secondly, just a long experience in running these types of absolute return liquid alternatives types of mandates. Myself personally, in terms of my background, I've about 15 years experience in the markets and 7 years buy side with Nick there at K2 and now at Munro for 4 years. And I'm a portfolio manager in the funds, or one of the portfolio managers of the funds, and I'm a partner in the business as well.
Oh, I have a bit of a question. The description of your portfolio management style says that you seek to generate risk-adjusted absolute returns through exposure to global growth equities over the medium and long term, while maintaining capital preservation mindset. Again, eye on the downside. Can you talk to us specifically about your approach to managing portfolio risk?
Yeah, thanks, Paul. So we have a number of sort of, first of all, I'd say our mindset is really protect capital first and make money second, and that's very strong. So when things do get difficult, we do move into capital preservation mode reasonably quickly, and then we sort of sit and wait, and then we try to make money again once, I suppose, it's last. So we have a range of tools that we use. So we have quite a flexible mandate in terms of what we're allowed to do. So we can hold up to 100% cash in the fund if we feel it's justified. We can short stocks. We can use option hedging as well, which was really, really handy in sort of COVID last year. We can reduce, or we move up and down our net and gross exposure. And so that's a bit of a technical term, but basically it's the amount of risk we're taking on. And we can also hedge or unhedge the currency as well, Canadian dollar, for Canadian dollar investors as well. So that's also quite a handy tool as well in terms of a risk-off, risk-on environment. As the last speaker mentioned, we're in a risk-on environment, so we want to be more hedged now. If you're sort of in risk-off, you probably want some exposure to sort of US dollars, etc. So there's probably 5 main tools that we use there to sort of manage the downside. And then we have a bunch of other tools that we use as well, just in terms of dashboards, in terms of telling us when risks are becoming elevated and when things are maybe ahead of themselves. And then also we run stop loss processes as well on our stocks and our portfolio as well. So they're really triggers to make us move if we have missed something fundamentally in our analysis. If we've made a mistake, we have a stop loss trigger, which basically tells us, okay, this needs to be reviewed. You're in the wrong stock here, or whatever it is. And basically it's a reaction function to move you away from that position. If your fundamental analysis has told you or has sent you the wrong way, I suppose, on a stock.
Yeah, James, one of the things that I like about your presentation is your view towards looking for trends that are emerging and how you approach those trends to create opportunities for investors. Can you just share a bit of information with us about what you see the trends are that are out there right now?
Yeah, thanks very much, Bob. So I think the big thing that we see coming out of COVID and into 2021 and beyond is actually on this slide here. And so these are just some of the areas of interest that we're looking at. So these big structural growth trends that are basically propelling these companies that are within them. And what you can see on this slide here, and the way to read this slide is these are effectively S-curves, what are called S-curves, or total addressable markets as well. And you can see the penetration down the sort of the y-axis there. And just an example, you can see US card, i.e. US digital payments, have gone from sort of 30% penetration up to sort of over approaching 60% penetration. And what we now see post-COVID is actually an inflection in that S-curve, i.e. people are not willing to use physical cash. They're moving online as well for their purchases, which means basically naturally you can't use physical cash. You need to use digital cash as well. And there's a whole range of other sort of drivers behind this faster transition to digital cash now. So so in terms of the key areas that we see sort of heading into 21, we still want to we've been invested in these areas down the right-hand side, the digital payments, internet disruption, digital enterprise, e-commerce areas of interest for a long time, but we actually want to be bigger in COVID. And actually when the markets were selling off, we were protecting capital using our risk tools, but we were actually then redeploying that capital back into areas of the market that we thought would be better off in a post-COVID world. And these were 4 classic examples of what we basically allocated capital to as the markets were falling. And so I talked about the digital payments area of interest. So one of our indicative positions there is PayPal. And you can see that we actually think that digital payments is going to quite quickly inflect and actually go to 100%, close to 100% penetration. So cash will almost go away in our view. And we basically want to be invested in stocks like PayPal, MasterCard, Visa, et cetera, to benefit from that as their earnings grow as a result of that structural change. The next one that we see is internet disruption. I won't labour on all of this because I know we're tight for time, but yeah, we just point out companies like Facebook, Netflix, Google, et cetera, continue to have this runway ahead of them, even though they're quite large companies. They're growing into very large total addressable markets. The next one down actually is workloads in public cloud. So these are cloud companies, and these are a key area of interest for us. And you can see the inflection that we think occurs post-COVID as well. So that's actually a pretty obvious one in terms of people moving to work from home, study from home, etc. So we think that's a pretty obvious trend to follow here. So we're obviously doing this meeting on Zoom today. And so Zoom is a stock within that area of interest. We're not actually invested in Zoom today, but that is a stock within our universe in this particular area. And we've got a number of positions there, including Microsoft. And then the bottom one there is an interesting one, I think, because it actually took, if you look at that curve there, you can see it actually took 20 years, best part of 20 years to get to 18% share from e-commerce. And then actually in 2020, it put on about 6 or 7% market share in the space of 1 year, and went to sort of 25% share. And we actually think it grows from that higher base there. So we want to stay invested in stocks like Amazon, HelloFresh, Alibaba, etc. So those are sort of some of the key things that we sort of learned in 2020, and we want to sort of build on into 2021 and beyond, I suppose.
Yeah, so we've had a few questions, and it appears that 12 minutes is sort of like a track meet out here to get things in. Some of the questions. So, given from Roy, given a significant part of the workforce will remain substantially remote, where do you see the investment opportunities are, and what will be the biggest winners and losers over time?
Sure. Shelby, could you actually go to slide 3 of mine, if possible, please? But there are a number of companies that are better off, obviously, in this type of environment. And so slide 3 will actually show you how we're positioned as a fund. And I think the key beneficiaries of this sort of remote connectivity type of environment is actually in that sort of digital enterprise, what we're terming to be digital enterprise. So this is companies that are helping transition workforces and so forth, these sort of digital transformation companies. And that's that second area of interest that we're investing in. And so actually about sort of 15% of our fund is invested in these types of stocks. So we have 5 of these positions. Our biggest position, or one of our bigger positions, is ServiceNow. But we're also invested, as I said, in Microsoft in this area of interest. We're invested in Atlassian, Adobe, and it's just escaped me, sorry. Atlassian, Adobe, ServiceNow, Salesforce, Microsoft. And so, yeah, we have 5 positions here, and these companies are all going to grow as a result of, I suppose, what we're doing right now. So is this sort of digital type of interaction. So those would be the key stocks I'd highlight there.
Okay, awesome, James. Thanks for your time.
Not a problem.
Next on our agenda is David Fingold. Now, there's a reason that we chose the panelists for this evening. I've followed David Fingold for many years and always enjoy his dedication, his passion, and his broad-based knowledge. David manages the Dynamic Global Dividend Fund as well as the Dynamic Active Global Dividend ETF. Now, David, you do a way better job of talking about your background. So let me just turn things over to you for, maybe spend a minute or so with us telling about your background and your approach to investing.
Look, it's going to be hard to get there in 60 seconds. I think what I usually start with is that I'm different than most portfolio managers because I used to work for a living. I graduated from business school 33 years ago, and I spent almost 7 years in manufacturing. So I actually have experience running a business, and I know what it's like to make payroll, and I know what it's like to deal with the bank and deal with customers that don't want to take delivery of product. And we had 450 employees, $170 million in sales. It was a real business. Then I spent several years as Canada's least successful private equity investor. The private equity valuations were so expensive at that time in the mid to late 90s that I actually liquidated the portfolio. I then joined Dynamic Funds. David Goodman, who was our former CEO, had just been promoted to CEO, needed an assistant, and hired me. And he let me start my first fund in 2004. We started with $8 million, and I'm managing over $10 billion now.
Paul?
Your mandates are global equity, David, with a focus on dividends. Obviously, this seems like a conservative positioning. And that's quite frankly why we have you in our portfolios. Can you talk to us about how you manage portfolio risk?
Yeah, I think first of all, that we approach the dividend policy of a company very different than most people do. Most people who are looking for dividends are looking for income, and we are not. So we've had an insight, which is the companies that grow their dividends are the best performing companies of all time. And also the companies that grow their dividends the fastest are also less volatile than the rest of the market. So it makes dividend investing sound very compelling. It's just that there's something very counterintuitive. The companies that grow their dividends the fastest are the companies that are initiating their first dividends, and the companies that have very low dividend yields, very low dividend payout ratios, and you're getting very little income from. It's just that they're rapidly growing their dividend. So this is not an income strategy. In fact, if you want to earn income, you're dramatically increasing the risk of the portfolio. So we look at the dividend policy very differently than really any other investor I've heard articulate. And the idea is to conservatively get exposure to capital growth within equity investments. The other aspect of it is, on top of looking at the dividend policy, we look at quality. When I was in finance class, I was taught that quality is a composite of profitability, a strong balance sheet, and the consistency of the profitability. I won't get into how we measure all those things. Those are basically proprietary methods of we do due diligence on the quality, and we're very good at scoring the quality of companies. And if you put quality together with dividend growth, again, you have an opportunity to dramatically reduce risk and get exposure to capital growth. And I should say, for one final point of view about this, is that all that stuff's very quantitative. You have to also understand that, I mentioned earlier I've run a business, and really what I'm looking for in the 25 companies you'll find in any one of my portfolios is that they're well-run businesses with managements that are strong stewards of capital, that own their own stock. In Mr. Buffett's words, they're eating their own cooking. So ultimately, when you're invested in one of my portfolios, you're not only a partner with me, because my only long-term investments, my only equities are the funds I manage. We're also partnered with 25 management teams, many of which are family-controlled businesses. So I just look at this as where we're trying to partner with people who are eating their own cooking.
Yeah, so David, I was reading a report today that said, from you considering all the data points, I see no reason to be pessimistic right now. So can you just talk
Sure.
Trends and opportunities?
So I would say, first of all, I mentioned David Goodman, who is our CEO. Our chairman, Ned Goodman, is really a legend in Canadian finance. You'll find him in the Canadian Business Hall of Fame. And he always said that he's an optimist because he never met a rich pessimist. And I thought that one of the most that was one of the most powerful things I heard. And I thought that if we're conservative and optimistic, in the worst case scenario, if something terrible happens, we pick ourselves up, we brush ourselves off, and we move on. So look, something terrible happened in March. And to be clear, we reacted to it. I was pessimistic when my indicators said be pessimistic. The Global Dividend Fund has the ability to hold cash. It went to 35% cash. Similarly, bad things happened in 2018 in December. That took us to 20% cash. If you go back to the inception of that portfolio in 2006, on at least half a dozen occasions, we were at 20% cash. During the global financial crisis, close to 40. But the point is, when I get pessimistic, it's in the short term because my indicators say to be pessimistic. We're looking to turn optimistic. We're waiting for everybody to get so pessimistic that it's time to get optimistic. And certainly we saw that opportunity in early April. So I'm going to give you at a high level what the indicators are that I look at, and today they flash green. So first of all, we're in a recession. I believe it's over. The National Bureau of Economic Research said that the recession started February 28th. They said that it may be the shortest ever. They have the sole discretion to determine when the recession starts and ends. If it breaks the record for the shortest ever, then it ended August 31st. If it ties the record, it's September 30th. So based upon what they've told me, I believe we're exiting recession, and this is the most compelling time to invest in equities. The other thing is, even if we trigger the shortest expansion ever, which is 12 months, then we're good until August or September of next year. And to be blunt, that shortest ever 12-month expansion was the one ended when Chairman Paul Volcker took interest rates to 20% for the second time. All right, when Powell says, I'm not even thinking about raising interest rates, then I don't think a Volcker 20 is on the table. So the market is acting exactly the way it always acts when it escapes from recession. You've got small caps beating large caps, you've got cyclicals beating defensives, you've got copper beating gold, you've got the yield curve steepening. These are the classic signs of the stock market telling us the economy is accelerating out of recession. So it's the reason to be optimistic. It's why all of our portfolios are near their fully invested positions, why we've taken advantage of our flexibility to buy small caps where appropriate, why we've got our maximum weights and cyclicals that are permitted within the portfolios. And that is the way we will remain until we get different information that makes me change my mind.
So
Okay,
David,
question.
we have,
Yeah, I'm going to jump over you there, Paul, and just another question, which is, can you give us an example of one or two companies which we might recognize that meet your parameters for rapid dividend growth from low payout ratio?
You know, because we don't own any of the companies with the high yields, basically I can name any of our companies and it's got rapid dividend growth. I mean, our quantitative analysis for our fund shows that we're most overweight the dividend growth factor relative to the universe of securities, and the second greatest overweight is quality. So I like to talk about companies where I think they've got a very interesting position, just given where the world's going and also where it is now. And I recently recommended Hoya, which is Hoya Corporation, is a Japanese company that we've owned for about 5 years. They're experts in glass. They're the world's low-cost producer and high-quality producer of eyeglass lenses. As any of us who wear glasses know, it's been difficult with social distancing to visit the optometrist or the ophthalmologist. So we think there's a lot of pent-up demand. Their competitor Essilor merged with Luxottica, so they compete with their customers, and that's made it much easier for Hoya to take market share. They also make endoscopes. They're the second largest endoscope producer in the world, and there's a lot of pent-up demand because it turns out that any of those procedures they call elective procedures. So as social distancing lessens, there's a backlog of procedures. So that's future demand for them. In near-term demand for them, they have a monopoly in glass substrate for hard disk platters. And if you convert a hard disk from aluminum to glass, you can have 13 platters instead of 11. So that's a pretty good increase in capacity. And over half the hard disks in the world can still be converted to glass. Then they're the monopoly supplier of the photolithography masks for all the leading edge nodes. So when you hear about 14 nanometer, 7 nanometer, 4 nanometer, et cetera, when you hear about immersion lithography, extreme ultraviolet lithography, this is where the best in class computer chips come from, the Apples, the NVIDIAs, the AMDs. The lithography, that whole lithography process is reliant on the photomasks from Hoya, and as I mentioned, they have a monopoly. So it's a company that has some very resilient businesses that have very visible growth, that are on the leading edge of technology, where they also have some pent-up demand from an improving economy. So I mean, I could give you another name, but you're going to hear the same themes. Stable businesses that are not feast or famine, and businesses within the company that can do a lot better in a growing economy.
Okay, awesome. So one of the things, Paul, that note from Shelby, our producer, and she just asked if, normally we don't get flooded with questions. We appreciate all the questions we've received tonight, but just to keep on track, we're hoping that some of our speakers can hang around a bit later to answer some of the questions that you are posing. But just for the matter of time, if you're okay with it, Paul, we're going to turn our attention to real estate. David, thank you very much for coming out and sharing your insights. Our next panelist is Kate McDonald. Kate is portfolio manager with Signature Global Asset Management. Signature is one of the top managers in the public real estate sector. And Kate joins us tonight. Now, in the area she's in, she doesn't have the broadband to be able to show her face. But Kate, thanks for joining us tonight.
So, Kate, I wonder, without the benefit of seeing you, if you could introduce your background, your area of expertise and experience, and just some of the things that differentiates your firm from what others do in the real estate sector.
Just checking, Kate, if you're on mute. Or have we lost Kate? Yeah, Kate, you look like you're on mute.
Can you hear me, Bob?
Yeah, we can hear you now. Yep, you're good to go. Technical difficulties. Yeah, so I think maybe just due to technical difficulties, unless Kate, try one more time. Maybe we'll move you, maybe you can try reconnecting and we'll vault you in it after Paul Sandhu. Does that make sense? Sounds like it.
So, Bob, why don't I move ahead with an introduction?
Yeah, let's do that.
Yeah, introduce a friend, long-term friend, and president of Marret Asset Management, Paul Sandhu, who's been on our huddles before. Paul, can you tell our attendees why bond investments should be managed by an absolute return bond manager at this stage of the market, and a little bit about Marret?
Yeah, so thanks, Paul. So first of all, just about Marret. Marret is a fixed income manager. That means we invest in bonds, and that is all we do. We specialize in investing in corporate credit, so we focus on investing in corporate bonds. But all of our strategies are incredibly flexible, so that just because we specialize in corporate credit, it doesn't mean that we have to be invested in corporate bonds. We think deeply about valuations, and if we think that the valuations and the risk reward in corporate credit is not that good, then we can be 100% cash, we can be 100% government bonds. Our mandates are generally very flexible, and that's what leads perhaps into your second part of your question: why focus on absolute return? Fixed income, people often look at bonds and think of fixed income as some sort of static asset class. And we think of it quite differently. Fixed income is made up of a whole bunch of different things. There are government bonds, there are corporate bonds. Within corporate bonds, there are investment grade bonds, there are high yield bonds, there are floating rate notes. So there's a lot of different components of fixed income. And at different times in the economic cycle or the credit cycle or the interest rate cycle, things that we pay a lot of attention to, by the way, each one of those different parts of fixed income performs differently. And so from our perspective, we want to have mandates that are incredibly flexible. We want to ensure that we understand where we are in the cycle and which part of fixed income will perform well. And so that's why we kind of focus on total return, because we want to be able to move from one part to another in fixed income wherever we think the best return will be. And 2020 is a very good example of that, because if the beginning of 2020, your fixed income fund or your bond portfolio should have been really high quality, right? In other words, you should have owned a lot of government bonds and very few corporate bonds, because first of all, corporate bond valuations were extremely poor. And as you move toward the end of the economic cycle, you want to have a higher quality portfolio, so you want to be invested in governments. And in fact, we didn't know there was going to be a global health pandemic, but that was exactly the way to be positioned, because in the first part of the year last year, in 2020, you wanted to have high quality, and government bonds did that for you. In other words, when we got to the health pandemic and we had lockdowns in March, government, we all know interest rates were cut. That meant government bond prices went up, right? And so government bond prices going up is obviously positive for our portfolio. And obviously at the same time, corporate bond prices fell. That would have been very negative for our portfolio. But once that change happened, once we started with a really high quality portfolio with a lot of exposure to interest rates and government bonds, that produced really good returns in the first 2 or 3 months of the year. But then we were able to move when valuations changed and the circumstances changed. We were able to pivot away from our position in government bonds and move into buying corporate bonds. And that's because corporate bond valuations at that point had adjusted significantly. From a historical point of view, corporate bonds became really cheap. And so then we then flipped the portfolio from government bonds into corporate bonds and focused on deriving the return from corporate bonds. And actually toward the end of the year, we actually sold some corporate bonds because we thought valuations got too rich. So that idea of being able to be flexible and to focus on which part of fixed income gives you the best total return within the context of the cycle is why we like the idea of one, being flexible, but number two, focusing on total return and not absolute return.
Yes, Paul, if we look at some of the charts, some of the straight corporate bond funds got absolutely decimated in March, right?
Mm-hmm.
So you're talking about that, and bonds make up a big part of a portfolio. Really the reason, why do you want to hold bonds in combination with equities in an overall portfolio? What role do bonds play?
Yeah, bonds play, that role of providing what we call negative correlation. Typically, what happens if everything else goes down, when we saw basically what we saw in March of this past year, when stock markets went way down, high yield bonds went down, corporate bonds went way down, the other side of that equation is that something lifts your portfolio. And that's why you want to have exposure to government bonds so that you can get something that's going up in your portfolio that counterbalances everything that is going down. And that's that idea of having something that does that counterbalance, or what we call negative correlation.
Yep. So a longer term investor who is investing in corporate bonds is not going to achieve that negative correlation, and they're going to really ride the equity roller coaster a bit, aren't they?
Yeah, well, this is why I think it's really important. I mean, one of the questions I think you asked some of your earlier participants was, what lessons did you learn, in 2020? And I guess our one of the lessons we've learned, and it's actually a really core part or core tenet of our investing philosophy, is to focus on valuation. So sure, we provide exposure to bonds, but it's also important to be mindful of what the composition of that exposure to bonds is, whether it can be government bonds or corporate bonds or high yield bonds or investment grade bonds. So you want to have a balanced portfolio, so you have something that negatively correlates, but at times corporate bonds and high yield bonds in particular will be correlated with stocks as well. So you want to be mindful of what are the valuations in corporate bonds relative to government bonds, and also understand that where you are in the cycle, are those asset classes going to produce, those asset classes of fixed income going to produce good returns in that part of the cycle? And if they're not, then you want to obviously have a higher quality portfolio, which is how we were positioned going into 2020. So we were able to provide that counterbalance. Bonds did actually provide that counterbalance if you were invested in high quality government bonds and had exposure to interest rates, and interest rates obviously subsequently fell because of the global recession. And bonds did what they were supposed to do, but corporate bonds didn't necessarily do exactly what they were supposed to do in that scenario. And that's why it's really important to be mindful of what the valuations are in the different parts of fixed income, and have your portfolio exposed to those parts that will actually provide that negative correlation.
Right, which is really quite difficult for a typical individual investor to rotate between government bonds and corporate bonds and know when to do it. Thus, right, an absolute return manager like yourself, who's really on top of it at all times, provides that unique service that we appreciate. Mm-hmm.
I'd like to go back, if I may, Paul, to your participation earlier on in the pandemic. I think it was the end of April. And yeah, I think your opinion at the time, there were sort of three headwinds to growth in the economy: too much world debt. I think since then there's a lot more. Low population growth and low productivity growth. Have your views changed now as we look at 2021 unfolding?
Yes and no. From a long-term point of view, they have not. I think it's pretty much a no-brainer to think that, to understand that we're going to have better economic growth in 2021 relative to 2020. I mean, in 2020, we had a recession, we had a global health pandemic. Going into 2021, we have vaccines, we have the deployment of vaccines, we still have, very accommodative monetary policy globally, and we have fiscal policy support as well, very broadly across the world. Those three things, the vaccine deployment, monetary policy, and fiscal policy support are going to provide obviously a better growth backdrop, in 2021 relative to 2020. And so, I buy into the fact that yes, in 2020, certainly at the beginning of 2020, even in fixed income, we should have more exposure to kind of riskier types of things in fixed income, like high yield and investment grade corporate bonds, because they will benefit, companies' cash flows will benefit from an improving economy, and therefore the value of those bonds should go up. So I believe that, but what I'm concerned about, Paul, is that those long-term headwinds haven't gone away, right? We still, as you have noted, we have more debt now than we did at the beginning of 2020, actually a very significant amount. And I think at the time when we spoke last, we showed you a chart where, global debt to GDP was at the highest in history, and that was at the beginning of 2020. It's even higher now, obviously. We have declining population growth, and we have had for 40 years. Unfortunately, and I say this very sadly, but the global health pandemic has actually impacted population even more because we've had so many deaths. And finally, productivity is still very low. And productivity, as we've talked about in the past, it's not a cyclical thing, it goes in really long waves. Those three things, the lack of, the huge amount of debt, which will be a headwind to creating a credit cycle, a dynamic credit cycle, which produces growth, and population growth and productivity growth, okay, are still major headwinds, which concern me post 2021. And I think that's one of the points I'd really like to make to your audience tonight, is that the narrative that we're building in the market, and maybe if David Fingold is still on, we'll have a debate about this, but the narrative that the market is creating is essentially that we are in a narrative of, we're in a cycle of increased growth and reflation, and that in fact, this is the beginning of a new economic cycle. I would suggest to you that, in my view, it's not the beginning of a new cycle at all, and that yes, we will have better growth in 2021. That's a given the conditions that we have. But the longer term headwinds that will prevent a really strong level of growth and inflation are still there, and so we need to be mindful of how we're investing in 2021. And then, what that actually means longer term, because if we're not in that period of higher growth and reflation, I have to tell you that the scary part of that, the scary alternative to that, is that we have reached policy exhaustion and deflation.
Well, I think, Paul, it's we never promised that everybody would have identical views. In fact, I think it's very important, actually. You spoke of non-correlation, and then even having different and opposing views from time to time in different asset classes in particular, I think leads to a healthy outcome. Paul, we want to thank you once again for joining us and for sharing your thoughts.
Yep. Now it sounds like from Shelby that many of our panelists are willing to hang around a bit and answer some questions. So, and it looks like we have Kate McDonald back on the line. Kate, can you?
I should be loud and clear, Bob.
Whoa.
Can you hear me?
Yeah, that's great.
What a relief. My apologies to you and to Paul and to all on the line. I do not know what happened earlier. I hit unmute and you couldn't hear me. But certainly it is a pleasure to join you today, and always a pleasure to provide an update on real estate.
Mhm.
So shall we go
Okay.
back to where we started?
Let's do that. Yep. So what I was saying
Wonderful.
is talk a little bit about yourself and your area of expertise and a little bit of something that is interesting that people would find, something people would find interesting about you and your managers and the way you manage money.
Sure, I'd be glad to. Briefly, I'm one of 3 equity portfolio managers at CI, focused exclusively on real estate and specifically on publicly listed or exchange traded real estate investment trusts or REITs, real estate operating companies, and to a lesser extent, companies that provide services to the real estate industry. Now, together with my team, I'm responsible for a number of real estate dedicated mutual funds and actively managed exchange traded funds or ETFs. The largest of which are the CI First Asset Canadian REIT ETF and the Signature Global REIT Fund. So in total, we manage over $4 billion in publicly listed real estate, which actually makes ours one of, if not the largest REIT dedicated investment teams in Canada outside of the pension funds. Now, in terms of what differentiates me from other investment managers, I'm a sector specialist, which means I'm laser focused on real estate 100% of the time. Real estate's been my passion and my focus since I kickstarted my investment career at Morguard many years ago. Now, since that time, Shelby, if you've got the slides up, if you go to the second slide, since that time, sophisticated, well-capitalized institutional investors have continued to allocate increasing amounts of capital to real estate. And that's certainly been true, certainly since over the last number of years for a number of reasons. Number one, real estate is a powerful portfolio diversifier. It's also an inflation hedge, and importantly, it's an important source of portfolio income or yield, which given the current anemic rate environment, I think is particularly attractive. Back to you, Bob.
Take it off mute there. So what did you learn from 2020?
Well, certainly 2020 has served as a powerful reminder of how quickly the macro environment can change. The setup for commercial real estate coming into 2020 was favorable, with operating trends very strong across most major property types and geographies. In March of 2020, of course, all of that changed as COVID spread and triggered lockdowns and restrictions effectively across the globe, and the macro environment shifted drastically in that environment. Now, as landlords to the broader economy, real estate fundamentals shifted with it. Now, what hasn't changed for us, and perhaps Shelby, if you go to the next slide where we talk about security selection, what hasn't changed for us is our investment approach. We've long favored REITs that own quality, well-leased assets in supply-constrained markets, and those that have healthy, flexible balance sheets stewarded by astute and disciplined management teams. And that approach certainly has served us well historically and served us well as we managed through the pandemic. Fortunately, the funds came into the crisis with a bias towards quality, well-capitalized REITs, and we had no exposure to either mall or hotel REITs, which of course have been particularly hit by the health crisis. So now as we look forward to broad deployment of a vaccine and a hopeful return to normal, our approach is unchanged. We remain biased in favor of property types benefiting from healthier supply and demand trends, and those with better line of sight on earnings and growth. So when we look back and think forward to 2021, certainly the view is mixed. Operating trends should strengthen broadly as health and safety concerns subside and economic growth rebounds. Now, importantly, we aren't avoiding the reopening trade, but we are trying to be very mindful of structural changes impacting certain property types, like non-dominant, fashion-oriented, or lower quality malls, which we expect will remain challenged for years to come due to shifting consumer preferences and the sharp rise in e-commerce that we saw through the pandemic. We have little appetite to chase beta, I'd say, in the current environment, and instead we've continued to emphasize property types that are more resilient and can defend well in an uncertain environment, particularly through the earlier part of this year. Coming into the crisis, throughout the crisis, and still today, we are very well weighted towards industrial. Warehouses, fulfillment centers have been clear winners amid COVID, in large part due to the surge in demand from e-commerce or higher online sales, which has fueled extremely strong tenant demand for space, which has served to push occupancy and rental rates higher, which certainly has benefited the fund's industrial REIT holdings. So lots of learnings in 2020 for sure.
So Kate, I'd like we've asked other panelists, I wonder if you could just give us an idea of where some of the risks lie, and then some of the specific trends. You've touched on that, but just where some of the risks lie, where we're at this inflection point.
Yeah, certainly. You might have heard, like, we've all heard the term K-shaped recovery, and we certainly see that in real estate, where operating trends and outlooks are highly bifurcated or uneven across the various commercial real estate property types. Now, in this environment, subsector allocation and stock picking are very important. Real estate is not a homogeneous asset class. Fundamentals do not move in lockstep across the various property types. This is true for the traditional property types like office, industrial, retail, multifamily. It's also true for the non-traditional sectors like single-family rental, data centers, life science campuses, and manufactured housing, just to name a few. So within the property types, the impact of COVID has been uneven. A good example would be multifamily residential, where tenants have left high-density urban apartment buildings in favor of suburbia. And that's created a big rush of tenants out of markets like New York City, like Boston, like the San Francisco Bay Area. And as a function of that, has driven occupancy levels down and market rents down sharply for urban high-density apartments. More so in the U.S. than in Canada, and certainly more so in Europe or in the U.S. versus the European markets. But that impact has been most pronounced. And so really keeping your mind, being mindful of those trends has been extremely important as we manage through this very volatile time where real estate fundamentals across the spectrum have shifted quite dramatically in the environment. Now, in terms of where we're seeing opportunity, it's very much where we are heavily weighted in our portfolios, and that is industrial, that we're seeing significant opportunity in the multifamily space and also in the single family rental space. So certainly as we've seen this mass exodus out of urban high density environments, we've seen a flight to suburbia. So it's benefited certain suburban apartment markets. It's also benefited single family rental, where we have a significant representation within our funds. In fact, our largest holding, Tricon Residential, across our funds has been a key beneficiary of this exodus and this preference for more space amid health and safety concerns, and also the ability to work from home has driven people out of the core urban areas into this type of housing. So certainly COVID has acted as an accelerant, bringing forward a number of trends that were ongoing impacting real estate. So work from home, e-commerce, increased data usage, certainly are trends that we are expressing through our funds, through overweight positions in industrial, single-family rental, and internet services and infrastructure, which reflects our data center REIT holdings, while underscoring underweight positions in retail and office. Paul, you've noted where are we seeing risk in real estate today? And it's really in these property types where it is very difficult to have any conviction with respect to what the future will hold for lower quality malls and also office buildings, given the trend and shift to increasing working from home. Now, in this low visibility environment, we have maintained very modest and very selective positions within office specifically, and we remain out of malls. We have no exposure to malls at this time.
Okay, so that's perfect. Now, thank you to
Bob,
panelists.
if I could just interject
Paul, if
with
you
a
wanna-
question.
Go ahead.
Yeah, because I noticed here, and it's obviously we have a macro trend of to an older population, and yet I noticed that you have a very minor portion in seniors housing. Is that something, Kate, that you see as a short-term issue? Is this in response to maybe some of the short-term challenges and maybe even lawsuits that might be experienced in that sector?
Well, that certainly is a risk, and it has always been a risk for long-term care and seniors housing, but even more so on a go-forward basis. Certainly long-term care and seniors housing has been caught in the crosshairs of COVID, and there has been significant human loss of life within many of the facilities. So certainly my heart goes out to the affected families. But in the interim, in advance of these populations being vaccinated, what it has meant is that operating trends have been very much under pressure, both for private and public operators. That being said, we do see with broad-based vaccination a return to more normal occupancy within the seniors family housing, which obviously will have positive implications for financial and operating results. So we do have a modest position within 2 Canadian seniors housing and long-term care providers, and we're comfortable with that weight, but we have not put more capital to work in those names more recently.
Okay, so Paul, I'm going to move on and thank you to the panelists for hanging around to answer some questions. Quick question for James right now. James, in terms of digital enterprise, what verticals do you see adopting tech at the highest rates as they go digital? View in industrial sectors going digital?
Yeah, good question. Look, I think it's pretty common. So sort of part of the reason we got involved with a lot of these digital enterprise stocks going back a few years now is because we actually got out on the road as a team, and we went to sort of different regions of the world and met with a bunch of companies across all these different sectors, and most of the meetings were talking a lot about their adoption of some of these tools, whether they be sort of sales tools, cloud-based sales tools, or sort of workforce management tools, or IT, remote IT help, or even connecting to your customers via sort of newer platforms like chat functions and so forth. So I think most businesses across most sectors are sort of looking at this, but obviously, I mean, some move faster than others. Obviously, generally governments are sort of further behind than, say private enterprises. US is probably the most ahead, obviously, probably the most dynamic of, I suppose, the corporate sectors out there. And interestingly, I suppose you could also look at maybe China as a bit of a laggard there in terms of shift to the cloud relative to, I suppose, what's happened in the US. So there's a whole sort of raft of different companies to invest in over time as I suppose that matures and sort of becomes more clear. We're not sort of investing in those Chinese companies at the moment outside of sort of Alibaba, and it's sort of cloud. Obviously, it's cloud business there, but yeah, there's a whole bunch of regions, I suppose, behind. But sort of across sort of developed sort of North America, I'd say that most businesses are across this now. So I wouldn't sort of call out any particular sectors as adopting any quicker than others.
A bond question for Paul Sandhu. Low interest rates, potential high inflation. Are real return bonds a better investment short term?
Yeah, that's one of the opportunities that we see in the early part of the year, for sure, Bob. I think when we look at the opportunity set in fixed income, we talked earlier about being flexible and going to that part of fixed income where we think we're going to get the best returns. The 3 areas that stand out for us at the beginning of the year: one is credit, to have exposure to high yield and investment grade credit, because we do think that corporate bonds will benefit from an improving economic environment. The idea of rising inflation is also a good important theme at the beginning of the year. So we do have in all of our portfolios what we call break-evens trades on. So we are essentially long inflation. So governments and actually even a few corporate entities do issue bonds that are linked to inflation. So if inflation actually is going higher, then the return on those bonds obviously is related to that. So we do have exposure to both corporate inflation-linked securities as well as U.S. government inflation-linked securities. And then the last opportunity we see early on in the year here in fixed income is the curve, both credit curves and government bond curves. That's a bit more of a kind of a sophisticated topic to sort of address. But obviously governments issue bonds right from 1 year all the way up to 30 years. Interest rates, obviously, interest rates across every one of those terms forms a curve. How interest rates move across that entire spectrum of terms can actually be, can actually give you negative or positive returns. So we do think that the idea of having exposure to the curve and what we would call a flattening yield curve, a steepening yield curve, is definitely another area where we will generate alpha from fixed income in the early part of this year.
Okay, quick question for David Fingold. David, if you look at a comparison chart of S&P 500 to Russell 2000, you see that starting in October, November, that you got dramatic outperformance in the small cap world over the large cap. What are your views about that?
Well, it actually started around April 1st. And you're right that there was a further acceleration, in the period in November. And I think I covered this earlier. It's just normal when the economy is escaping recession, small beats large. Right. So it's just consistent with every other recovery. What's interesting about this is I find that. Well, look, Mr. Buffett once said that the one thing we've learned from history is nobody learns from history. So it's astonishing as I think about the questions that I get. It's clear he was completely right. Everybody feels that they live in unprecedented times, and they don't. There's I forget where it is in Ecclesiastes. I think it's very early. It's around, chapter 1 or 2 of Ecclesiastes, which talks about the concept of an eternal return story, where basically everything that has happened before will happen again, and nobody will recognize that that's the case. And I'm paraphrasing it. It's actually much more beautiful the way that's written in Ecclesiastes. So, I think there've been questions. What did you learn about 2020, from 2020, or how was 2020 different? The answer is it wasn't. There's been, it's like, every other year, good things happen and bad things happen. When there's recessions, worse things happen. There's been a lot of pandemics during my lifetime, been a lot of recessions in the last 50 years that were at the exact same time as pandemics. I don't want to minimize the losses people have experienced, but let's keep in mind, people also had losses from Hong Kong flu, from the Siberian flu, from the Spanish influenza. There have been terrible losses people have experienced. And, so we've lived through these things before, and they're going to happen again.
Yep, things do repeat. Kate, real estate question for you. Kate, what is your view on the role of real estate sector's need to adopt new technologies to provide increased returns and resilience?
Oh, great question. And certainly the adoption of and rollout of technology within the real estate universe has been fairly slow, outside of the obvious being data centers, cell towers, etc. Many of the apartments REITs have recently rolled out things as simple as revenue maximizing software, etc. So it's certainly been a very slow progression on many fronts. In the US, you're seeing the appointment of more like chief technology officers, where certainly technology is a key focus for many of these issuers. I would say where technology has been most beneficial is within the single family rental business. So of course, issuers going out and buying single family homes at scale and leasing them out to tenants. And really that business was a very fragmented mom and pop business prior to the global financial crisis, when big institutional players got involved in scale and with technology could drive significant operational efficiencies and really made that business viable. So self-showing technology and many others have subsequently been rolled out across more multifamily homes, but the first mover in many of those cases was the single-family rental. So that's certainly where I'd point to, where technology has enabled great operating efficiencies. And actually, for many of the players who have subsequently adopted this self-showing technology, there will be long-lasting operational cost efficiencies on a go-forward basis coming out of COVID.
Okay, a couple more quick ones. I'll throw this up to the panel. Anybody who wants to take a shot at it. Given the debts incurred by governments that are still being issued, just how do we start to repay this and reduce debt over the next 5 years? If that's possible, to what degree will increased taxes dent and reverse the market exuberance currently so prevalent?
I can volunteer if you want.
David's got his hand up. Yep.
Yeah, first of all, debts don't get repaid. That's not the way how it works. The bonds are going to mature. The debt to GDP will fall because GDP goes up. That's the way the US, quote unquote, paid back the debts from the Second World War. But that's normal. This idea that you have to repay them is ridiculous. The other thing about it is this idea that the debt is bad is also ridiculous. The savings rate's at a record level. So unless the government was borrowing that money from households and spending it, the economy would be shrinking, we'd be facing deflation. So unless households are willing to spend a lot more money and reduce their savings rates, the government needs to issue debt in order to soak up those savings. Anyway, it's a neo-Fisherite view. I don't know if anybody agrees with me. My view only works in reality. It doesn't work in theory.
Okay, a quick one for James. Do you use tips, James?
No, we're an equity fund. So if we want to protect against certain events like market events, we can use shorts, we can short index futures, options, etc. But it's all pretty much equity based. So
right.
Yeah,
but you did. I think one of the reports that I saw that you were actually shorting yields, weren't you?
Yeah, we were in terms of an ETF, yeah, and that's to protect against rising interest rates, which we thought might occur with particularly with the stimulus package from the US, but that's really to protect our equity portfolio, to be honest. Like with, as I've sort of talked about, I mean, some of the questions have been about some of these digital enterprise stocks. And we typically, as a growth fund, we're looking at stocks which are growing for multiple years, and generally you're paying a higher valuation multiple for that. And so if bond yields go up, not to sort of bore the audience too much with the theory of it all, but basically your discount rate goes up. And so when you're looking further out for growth, you're basically discounting that growth back to today's present value. Or that target price back to today's value. And so if the interest rate goes up, then that basically mechanically brings down your target price of what you think a stock is worth. And so that's just something that we need to sort of manage just from a sort of short-term valuation perspective and sort of a rotation risk in the market perspective. It's not actually going to affect, if rates go up by 50 basis points or something like that, it's obviously not going to affect how many subscribers Netflix signs up and how many parcels Amazon delivers, etc. It's not actually going to affect the success or failure of those businesses, but it can have a sort of short-term valuation impact on the market. So that's more of a hedging tool for us that we would use. We don't typically do it. It's quite rare actually. It's just particularly into this sort of catalyst with the stimulus package and so forth.
Okay, so James, I've got you on the line. Final thought?
My last slide actually, which I didn't quite get to, was actually about climate change. And so some of the questions about debt and tax and so forth. So a lot of this stimulus package is going to be directed at climate change in the US. And obviously we know that what's happening in Europe in terms of decarbonisation, and I spoke a little bit about digital transformation that every company that you meet with talks about, but actually every company that you meet with talks about, another thing they talk about now is their ESG score or their environmental social governance score, and environmental being the big one. And so we've been, I suppose, quite lucky to have been positioned in sort of tech for like the last 10 years plus, and that's been a huge contributor to our funds in terms of an area that we've made a lot of money out of. But actually, we think climate change over the next 30 years is the big one. And so we're going to, you might have quickly seen on that slide, our biggest area of interest is actually climate, 17% of the fund. And within that, I think there's a range of, oh, thank you, I'm getting the slide up. We actually think there's a range of areas to sort of make money here. You just sort of follow the money is our job. And so you see sort of the pie chart of how actually the Europeans are going to spend their $7 trillion that they're talking about over the next 30 years. And so we've just made an estimate. The globe is going to spend 3x that, because it's obviously European Union, 27 countries. This is going to be much bigger globally. And we would sort of highlight perhaps the renewables. So 18% there of the capex is going to go to renewables, and that would be investing in companies like NextEra in the US, or Ørsted in Denmark, the biggest offshore wind developer, or Vestas, the biggest onshore wind turbine manufacturer. So those type of stocks. So we're pretty excited about that for the next 3 decades, effectively.
Yeah, awesome. Well, James, thanks very much for joining us tonight. Paul Sandhu, final thoughts.
My final thought really focuses on risk mitigation. How do you mitigate risk when all assets seem to be, quite inflated? So, in the past, you talked about this earlier, Bob, owning bonds for negative correlation. But some people now are beginning to argue, and I wouldn't accept this argument, but some people are arguing, well, if interest rates are so low, do bonds give you that traditional negative correlation? The other things that people have typically used for risk mitigation are, you buy government bonds, typically US treasuries. Maybe you go long the US dollar, so because in times of trouble, the dollar goes up, or you buy gold. And I question whether, you can question whether all those risk mitigators or traditional risk mitigators are going to work as well. And to me, what that brings me to is the idea that perhaps cash is a bigger risk mitigator than it has been in the past. And it takes on greater importance if those other things are not going to do as much work for you as they have done in the past. And so you may have to be more tactical in raising more cash. But then the question becomes, well, cash isn't earning me anything. So if I actually move to cash to mitigate risk, then I'm not really earning anything. So the challenge becomes number one, find a good cash alternative where you can earn some decent amount of money with cash. And I'm happy to talk to you about in depth about that offline. But secondly, to think about the fact that you may have to have higher cash levels, as we get continued rising in asset prices. You may have to, if you get worried or if you think asset prices are overvalued, certainly in corporate credit, we think at some point this year, asset values will be overvalued, and we're going to have to do something. So we're either going to have to buy government bonds, or we're going to raise more cash. And cash may be a more important risk mitigator in the future than it has been in the past, relative to other risk mitigators that we traditionally think of.
Okay. Thank you very much for joining us this evening. David Fingold has a big smile on his face there. David, I've heard you say, I'm an equity manager, I'm not a cash manager.
Oh,
what are your final thoughts this evening?
Well, look, for purposes of full disclosure, I run an asset allocation fund as well that has the ability to own any asset that can be legally owned within a mutual fund. And in fact, we have exemptions to own some other assets as well. So, I have, I will raise cash. To my knowledge, the only 3 Canadian PMs, or let's say PMs who are available to Canadian residents who've ever taken an equity fund from fully invested to 40% cash and back to fully invested were me, Peter Cundall, and Jerry Coleman. And Jerry's retired, Peter passed away, and you're stuck listening to me. But when you raise cash, you have to be right twice. And I think we've shown over the last, I guess it's now pushing 17 years, the continuous record being right more often than not about when to raise cash and when to put it to work. I do think the cash is very powerful. It does make sense to have dry powder. Our global dividend fund never goes under 5% cash, and it shouldn't make such a difference to be 95% invested instead of 100% invested. But clients have been very generous in giving us money, but they don't always give us money, and I guess it means we're never forced to sell anything if the clients want cash faster than we're expecting. I'm very sympathetic to the comments about the overvaluation or potential overvaluation in the bond market. We exited corporate bonds in 2014. We were very aggressive buyers during the crisis. You were able to get corporates at 60 or 70 cents on the dollar, and in 2014 we got par, so we exited. Because unfortunately, when you're at par with a corporate, you can get called at 105, mature at 100, or there was a recession and you fall back to 60 or 70. Our government bonds got excised from the portfolios around the same time because we started to get corrections where government bonds refused to increase in value. So the only thing we have in our asset allocation fund within the fixed income component is something that technically under Canadian accounting rules is a cash and cash equivalent, and that's US Treasury bills. So we've actually benefited from that negative correlation of the US dollar, and in every correction since 1970, the US dollar's gone up. We've had no exposure to credit. And unlike US dollar cash, the yield can go negative and you can get a capital gain on your treasury bills. And that's what happened to us during the second quarter. So, that's been my take on it. I didn't invent that, by the way. Using US Treasury bills and waiting for them to trade above par with a negative yield. I learned that from Mr. Buffett. He mentioned it at the 2009 annual meeting. And I thought, what the hell, let's copy it.
Yep, there are no new ideas, right?
Exactly. Look, Charlie Munger was asked, and I can't remember if it was at that meeting or if it was 08 or 07. I've gone 6 times and they all blur together. A teenage boy asked Mr. Munger, what should I do if I want to be like you? And Charlie said, get as much broad life experience as you can. So let's just call that learning. And secondly, learn as much as you can about accounting. So, I think maybe concluding on something that Charlie Munger said is probably, the best place to conclude. Because, my hope is to have, a tenth of the ability and the success that he had, because, given my investments are identical to my clients, we'll all do really well if that's the case.
Mm-hmm. Awesome. Thank you for joining us this evening.
Thank you for having me on. Good night.
Good night. And in batting cleanup, Kate McDonald, final thoughts.
Wonderful. Well, thank you. Certainly, we expect better performance out of the REITs as we look forward to 2021. Certainly, as landlords to the broader economy, we do think that the REITs as a group should be able to recover as we begin a new growth cycle. We are seeing continued discount valuations in the space, both in terms of how we look and value REITs on a price to net asset value basis. We also think the sector looks attractive relative to bonds. And importantly, we think that the REITs, particularly in certain subsectors, are trading at massive discounts to where like assets are trading in the direct property market. And we do think that in that environment, given institutional allocations to the sector broadly are rising, given that pension funds and sovereign wealth funds are actively reevaluating their allocations to government bonds in this anemic and, in fact, negative yield environment. So we do think that real estate increasingly will attract capital. And as it does, we continue to expect a robust transaction market, particularly for those property sectors where we have the bulk of our exposure, so multifamily, industrial, et cetera, sectors that are propelled and supported by tailwinds, which we expect to remain firmly in place as we move forward to the new year. So we see attractive total return potential from the group, driven by a combination of yield and free cash flow growth in 2021. But that's not to say we have a rosy view of REITs broadly. Very important to pick your spots.
Mm-hmm. Kate, always a pleasure having you on our panel. Thank you for joining us this evening. And this concludes this Huddle special event, Outlook 2021. Many thanks to our panelists and also to Thomas Galikowski and David Kulig, who helped us to organize this panel this evening. Also, a big thank you to all of our attendees. We had a very large audience and most of you have stuck with us right through to the bitter end. Hopefully this is a good way for you to gain a better understanding of different perspectives from our panelists, as well as, hopefully a good way to spend some time during COVID shutdown time. I'd also like to thank our wealth advisors and our accounting affiliates for inviting many of our guests, and a special thank you to Shelby, our producer of this event. This presentation has been recorded and will be emailed to everyone who registered for Outlook 2021. Please feel free to pass it on as you see fit. We will also be releasing our Wealth Stewards Investment quarterly performance webinar early next week. This will be a recorded session only, and we'll discuss how our portfolios performed in one of the most unusual years that we will ever experience. So thank you very much to everyone for joining us this evening. We appreciate your attendance, and please stay safe.